Who are the key players that dominate and influence the crypto market the most? Okay, in any market, when there is trading going on like stock, crypto, or your town's local, well, doesn't matter. It's always a battleground of two key players, buyers and sellers. No more, no less. But if it's that simple, why do we even need to explore this topic? Well, to truly succeed in this high-stakes game, you must understand the intricate strategies and behaviors that define these participants. Of course, to be successful in the world of crypto trading. And of course, you should know who are the ones that control the market the most. So let's find it out in today's video. Okay, as we know already, the market is like a gladiator arena where fortunes are made and lost. And it's a fight between two key players, buyers and sellers. But what are the most common strategies and behaviors of participants in the crypto market, and what drives their actions? Let's break it down. Okay, so on one side of the ring, we have buyers, the driving force behind crypto's rise. Buyers usually enter when prices drop, and it seems like these are the individuals who believe in the future of cryptocurrencies. But actually, it's not that simple. Not all buyers are created equal. Of course, they come in various shapes and sizes, each with its own strategies. And of course, there are many different complex terms for naming them, but normally experts define three main types, like static buyers, who work with the same price, dynamic buyers, who close shorts or buy on the market, and long buyers, who build positions for themselves in the hope of price increase. However, the crypto market is quite intricate, and you might encounter some, unique terms for that specific market. So let's explore those. So first, we have hodlers. Hodlers are long-term investors who buy cryptocurrencies and believe in the long-term potential. Yeah, it may seem, straightforward at first glance. Just buy some crypto and, do nothing but hold it for an extended period. However, it's not that simple to actually withstand short-term price fluctuations in, the overall volatility of the crypto market. That is why hodlers are true believers who embrace crypto for the long haul. They weather market storms and hold on their digital assets no matter what. So, all that for that sweet long-term gain. By the way, do you know why people, in the world of cryptocurrencies say hodl, not hold? Actually, this term originated from a misspelled word in the Bitcoin forum post back in 2013. So, in a post titled, "I am hodling," the author, presumably in a state of excitement or frustration, misspelled holding as hodling. So, this post has since become famous in the cryptocurrency community, and the term hodl has been adopted, to mean hold or keep rather than selling or trading cryptocurrencies. Then we have traders, who feel like fish in the volatile crypto waters. Crypto traders aim to profit from price fluctuations in, relatively the short to medium term. Of course, there are just several types of crypto traders, each with its own advantages and disadvantages, but the main ones include day traders, swing traders, and scalpers. So let's break down each and see their specs. So day traders. These traders buy and sell cryptocurrencies within the same day, capitalizing on intraday price movements. Then swing traders. Swing traders hold positions for several days or weeks, aiming to profit from larger price swings. And we have scalpers, who make quick, small trades to profit from tiny price movements. They may execute dozens or even hundreds of trades in a single day. And by the way, guys, if you want to learn more about these trading types, like their strategies, time frame, risk management, and psychology, just leave a comment below and we will break down this topic in depth. Next, don't forget about arbitrageurs. If we continue our association list, they are the detectives of crypto. These traders seek profit from price differences between different cryptocurrency exchanges or trading pairs. They buy low on one exchange and sell high on another, exploiting price inefficiencies. Crypto arbitrage, while potentially profitable, is pretty expensive game, and also can be, well, quite dangerous for several reasons, like execution risk, fees and costs, market liquidity, and so on. And besides, it's a pretty popular ground for scammers these days, so be extremely careful when someone offers like arbitrage with high profits. That's why I just don't recommend this for complete beginners. Last but not least, these are large financial institutions, hedge funds, and investment firms. These financial giants play the game by their own rules, with massive investments, insider info, and diverse strategies. So their strategies can vary widely, including long-term holdings and trading. So in other words, it's a major league. Now, let's shift our focus on the other side of the ring, the sellers. They have their tactics too, and even more intricate. First, these are profit takers. Some sellers in the crypto market sell their holdings when they believe the price has reached a satisfactory level or when they need to realize profits. And yeah, they may be long-term investors or traders too. When the market starts to fall rapidly, it's likely due to long-term sellers who are aggressively getting rid of their assets because they just believe it will not grow up anymore, or they have already made a profit and just want out. Next, we have limit sellers. So these limit sellers are usually the ones who create resistance levels and later become limit buyers. Next, short sellers. Well, of course, the infamous short sellers. These are, knowledgeable individuals. Short sellers bet on the price of a cryptocurrency declining. So they borrow the cryptocurrency from the exchange or elsewhere and just sell it right away at the current market price, and then aim to buy it back at a lower price later to return it to the lender, making a profit from this price difference. And yeah, their presence on the market can be easily detected as they possess more information than others, like inside info, and of course, prevent the market from breaking through certain levels. There is also this noble fraction that keeps the crypto market afloat. Yeah, market makers provide liquidity to the market by continuously buying and selling cryptocurrencies. They profit from the spread, the difference between the buy and sell prices, and aim to facilitate trading for other market participants. And of course, guys, just remember that each of these buying and selling types and styles has its own advantages and disadvantages, and not all traders are suited for all styles, because each has its own individual goals, risk tolerance, behaviors. So successful trading often depends on traders' personality as well. And finally, let's talk about the ones that influence the crypto market the most. And that's right, these are crypto whales. So the whales, the big fish in the crypto ocean, holding massive quantities of single cryptocurrency, and they are capable of making waves just with a single buying or selling transaction. Just, can you believe that? So indeed, they are the ones who influence the market the most, and you just gotta live with that. Of course, not all crypto whales engage in manipulative or detrimental activities, because some large holders are legitimate investors or early adopters who have contributed to the growth and development of the crypto ecosystem. Well, nevertheless, the actions of whales, whether intentional or not, can have a significant impact on the market dynamics. So that's why traders and investors should be extremely aware of these dynamics and exercise caution when making decisions in the crypto market. Okay, so back to our initial questions, like why is it also crucial and why should you care about who's buying and selling in the crypto market? Well, how to put that simple? It's because when you know the rules of the game, you can learn how to play it super well. So, understanding the strategies and behaviors of buyers and sellers is your secret weapon for successful trading. Basically, it helps you anticipate market movements, make informed decisions, and navigate the crypto landscape with confidence. And of course, these strategies and behaviors can coexist within the crypto market, and participants may adapt and mix and match their approaches based on changing market conditions and their risk profiles. Besides, the crypto market is relatively young and can be influenced by news, social media, and regulatory developments, further impacting buyer and seller behavior. That is why it's important to stay updated and pick sides judging the current market sentiment. But the last question remaining is, which sides would you pick?